All right, welcome to The Explainer. Today we're unpacking absolutely the most powerful financial force on the planet. I'm talking, of course, about the Central Bank of the United States, the Federal Reserve. Look, the Fed is literally the architect of our monetary policy, and their decisions dictate the valuation of every single financial asset out there, from the savings account at your local bank all the way up to global equity markets. They run the show. If you're going to participate in these markets, you absolutely have to understand the mechanics operating behind the curtain.
Okay, let's dive right into this, because this is where so many people get tripped up. The Fed doesn't just sit around in a boardroom picking a random price for a share of Apple or a barrel of oil. It's way deeper than that. They operate at the bedrock level. To navigate this environment, you have to wrap your head around one crucial concept. The Fed adjusts the price of the currency those assets are priced in. They control the money itself, which in turn ultimately controls everything else.
Section 1. The Dual Mandate. Congress's Directive. So to understand why they manipulate the currency, we've got to understand their core mission. And honestly, it's a bit of a tug of war. They have two goals that are basically constantly fighting each other. On one side, you have price stability. The Fed wants inflation humming along at about 2% a year. If prices start rising way too fast, they have to tighten the money supply, essentially making cash harder to get so they can cool down everyone's spending. But then, on the exact opposite side, you have maximum employment. If unemployment spikes, the Fed has to rush in and make borrowing cheaper so businesses can afford to expand and hire people back.
It's a never-ending high-wire act. They are constantly balancing the fight against inflation with the need to keep the economy actually growing. And more often than not, they have to sacrifice one just to save the other. Because they are tweaking the price of the currency and not the asset itself, this balancing act creates absolute massive volatility in the markets. Seriously, every single policy announcement they make forces the market to completely recalibrate asset prices across the board.
Section 2. The liquidity valve, controlling capital.
So how are they actually pulling off this balancing act? Well, it all comes down to interest rates. You've probably seen the scary headlines before, right? Fed hikes rates, and suddenly the stock market is taking a nosedive. But why does that actually happen? It starts with something called the federal funds rate. This is basically just the interest rate commercial banks charge each other for overnight loans. I know it sounds like some super boring back-office banking mechanic, but believe me, it is the benchmark for the entire global financial system.
Let's trace how this builds. When the Fed hikes that overnight rate, borrowing costs shoot up for everybody. The banks just pass that extra cost right down to you through higher mortgage rates, brutal credit card rates, and massive corporate loans. This acts like a giant vacuum, draining disposable liquidity right out of the system. And as money gets more and more expensive to borrow, the hurdle rate, which is the absolute minimum return an investor demands to justify taking a risk, goes up. Capital gets terrified and immediately flees risky stocks, running straight for the safety of guaranteed returns.
If you are actively putting money to work in these markets, you literally cannot fly blind. You need to see these capital flows happening live. To track these massive liquidity shifts, save $15 using our referral link in the description to get TradingView, which is frankly the absolute standard in charting. You're going to need it to follow these complex markets efficiently.
Section 3. Pricing the stock market. Yield competition. Let's look at exactly how those interest rates physically alter stock prices. It really just boils down to discounted cash flows. See, Wall Street algorithms price companies based on the cash they're going to make in the future. When rates are super low, money is cheap, and those future earnings look amazing. Money pours into stocks. But what happens when the Fed raises rates? Suddenly, a totally risk-free treasury bond is paying out a guaranteed 5%. Think about it. Why on earth would an investor risk their hard-earned capital on a volatile, high-growth tech stock when they can get 5% for doing absolutely nothing? High interest rates actively suck capital right out of the stock market and dump it into safe bonds, which instantly drops the intrinsic value of equities. And that brings us to a massive takeaway you need to internalize. Liquidity is the absolute lifeblood of active trading. It's what lets you get in and out of positions smoothly. Interest rates act as a literal valve controlling the flow of that liquidity. When rates go down, the valve opens wide and cheap cash just floods the market, aggressively chasing riskier assets. But when rates go up, that valve shuts tight.
Section 4. Open market operations, managing supply.
Now, adjusting the interest rate isn't the only lever the Fed can pull. If raising rates just changes the cost of borrowing money, how does the Fed actually physically erase money from the system? They do it by getting their hands dirty on the open market, directly buying and selling government securities.
This mechanic splits the market into two very distinct environments you've got to be able to recognize:
quantitative easing, or QE, and quantitative tightening, or QT. When there's a huge economic crisis, the Fed hits the panic button with QE. They buy up massive amounts of government bonds, injecting brand new cash straight into the banking system to stop it from collapsing. But, eventually they have to clean up the mess and reverse that process. That's QT. They either let those bonds mature or actively sell them off. This effectively destroys that cash and rapidly shrinks the monetary base.
So the crucial point for us here is this. Quantitative tightening acts exactly like the tide rapidly rolling out. As the Fed actively deletes money from the system, the everyday buying support we're all used to just vanishes. For the everyday trader, this creates a wildly precarious environment that is highly prone to flash crashes and violent drops in asset prices. That nice, comfortable liquidity cushion is just completely gone.
Section 5. Deciphering Fed Speak. Forward Guidance.
The Fed knows perfectly well that markets are always looking forward, not backward. Actually, have you ever noticed this insane paradox? A jobs report comes out saying employment is super strong, the economy is absolutely booming, and the stock market immediately crashes. Wait, what? Why does that happen? Because the market isn't reacting to the good news itself, it's reacting to what that news means for the Fed's dual mandate. If the news is a little too good, the market instantly assumes the economy is overheating, which will force the Fed to step in and hike rates to cool it down.
To keep the market from completely losing its mind, the Fed manages these expectations through a practice called forward guidance. Since Wall Street prices in rate changes months and months before they actually happen, the Fed just tells everyone what they plan to do way in advance. They even put out this thing called the dot plot, which is literally a chart showing exactly where every single Fed official thinks interest rates are going to be over the next few years. This forward guidance is exactly how we categorize their language into two camps, hawkish and dovish. If a statement is hawkish, it means they are super worried about inflation and they're getting ready to tighten policy. If it's dovish, it means they're sweating over economic growth and they want to ease things up. Traders out there will obsessively parse every single syllable of these statements, hunting for the holy grail of market signals, the Fed pivot. That is the exact precise moment they shift from hawkish to dovish, which historically marks the explosive start of a massive new bull market.
Section 6. Forex and the dollar, currency markets.
Before we wrap this up, we have to pull the lens back just a little bit, because the Federal Reserve is not just a domestic player. Their decisions send shockwaves across the entire globe. When the Fed raises rates, the real yield of holding US dollars goes up compared to other fiat currencies like the euro or the yen. And global capital, it is always starving for yield. So international investors dump their local currencies and aggressively buy US dollars to lock in those higher returns. This makes the dollar incredibly strong, but it's a huge double-edged sword. A strong dollar is fantastic for attracting global capital, but it makes American exports incredibly expensive, which can absolutely crush the earnings of large multinational corporations.
Getting a grip on how the Fed pulls these strings, from the overnight rates to open market operations, all the way to forward guidance, is exactly what separates the reactive traders who get chopped up from the proactive ones who capitalize on the moves. To master trading in this environment, you need to grab your copy of the Funded Micro Modern Future Strategies for the Propform Era at franksreport.com. So next time the Fed chairman steps up to that microphone, don't just blindly listen to the words. Ask yourself, are they opening the liquidity valve to fuel the next massive bull run, or are they quietly shutting it down, leaving your portfolio totally exposed? Thanks for hanging out for this explainer, and stay sharp out there.